My name is John Riggs from PricewaterhouseCoopers, PwC. Happy to be your moderator today alongside my colleagues and friends, and looking forward to sharing a bit with you today on the concept of second-level thinking, second-level investing. So right before I dive into some quick introductions down the line and have each of our panelists today share a bit more about themselves, about the investment units that they lead, and about some of their own personal examples of second-level thinking, thought it would be wise to just spend a moment and say, what are we talking about? You'll note in the outline for today's session the reference to Howard Marks, and he is the father of the concept, second-level thinking, second-level investing. What is that? What does that mean? What is first level? What is second? What is third? The concept is very simple. It's considering investment opportunities beyond the traditional approach, beyond the traditional view. You look at a business plan, you look at a set of entrepreneurs, you look at their offerings, you look at their pipeline, their revenue forecast, you look at their costs, their margin, etc. You look at the addressable market that they can attack and the share that they expect to achieve. And from that, you derive some view of cash flow. You derive some view of break even, some view of the need for funds and the use of those funds. And you arrive at what your valuation is for that company, what the pre and post capitalization of that company looks like, and you arrive at what you believe is a fair price. And that's the traditional approach to investing. Second level investing takes all of that, considers it, and then files it away. Because second level investing is about looking for the things that you can't see in the numbers. It's the things that aren't obvious. It's the non-traditional views of a company, its plans, its value proposition. In many cases, it's quite strategic, because second-level thinking often involves considering what you know that others don't. And what you most often know that others don't is about your own capabilities, your own competencies, your own portfolio, your own plans. So second-level thinking goes somewhere that other investors are not going. It allows you to see a potential or an opportunity where others simply don't see it. So we said, how can we best convey this to our esteemed colleagues and friends and those that are attending this conference? So, well, let's have 4 individuals join us today and talk about their own personal examples of second-level investing. So with that quick introduction, we're going to go down the line. We have Joel Volpe here as the Managing Director of the Global Innovation Fund and the General Manager of the Global Health Private Equity Fund. We have Michael Chisano, who's the VP and COO of Johnson & Johnson's Development Corporation. We have Bo Ilso, the Managing Partner of Nokia Growth Partners. And we have Jacqueline Lesage-Krauss, the Managing Director of Munich Re HSB Hartford Steam Boiler Ventures. So with that, I'm going to ask Joe to kick us off. Each of the panelists is going to take about 5, 6, 7 minutes, take a couple of slides, no more than a handful, tell you a little bit more about themselves, about their investment area, and about their example of second-level thinking. With that,
Introduction
Joe.
first, or get a...
You can go ahead and cover both.
I'm going to stand. Okay, so good morning. Thanks. Thank you. My name's Joe Volpe, Managing Director within the Global Health Innovation Fund, and also General Manager of the PE Fund. And the reason I repeat that again is that's very important for second-level thinking, to have access to venture funds and a venture strategy coupled with a PE strategy. Bill Taranto has often given talks on our group. Just as a reminder, we're a $500 million venture fund, a $700 million private equity fund. We go later stage. We ecosystem invest, and I'll explain that a little further in terms of some of the examples of where we ecosystem invest and second level invest and strategize. So with that, I'm going to take you through kind of the approach of our investment thesis and how we go to market with portfolio companies as we take a look at them. So as we had already talked about, John mentioned the company in terms of investing in a company from a financial standpoint, the CEO, the market, and what they're up there. That's kind of the normal strategy of how we move forward. But we take it to a secondary and even a tertiary level where we start to look beyond where that company can go and how it's going to strategically fit into the industry. So not just how the company's going to do and what they're going to deliver in terms of their widget, but how they're going to move forward and how they fit into the ecosystems we invest in. We invest in 7 ecosystems. I'm going to go through one, which is in remote monitoring, but we're in others. We're in HIT, we're in precision medicine, we're in diabetes, we're in oncology. So there's many that we're doing this for, but I'm going to give you one example. And then lastly, where you might think if you start to invest like that, as you culminate a lot of investments, they can leverage each other. So if you're investing, for example, in patient-physician engagement, so a portal where physicians come, and you do a very good job at that, a lot of your other investments can actually flow through that and leverage it. If you're investing in infrastructure, or IT, or technology, or security, or analytics, a lot of the portfolio companies and investments that we're investing in need that. So we try to match them up and leverage them, and it works. 1 + 1 = 3. They start to kind of ride each other's coattails. The way we do it, and this second chart to the right here, is called a growth strategy framework. I implement an exercise with every single portfolio company I invest in, sometimes before we invest in them, sometimes after, it depends. And basically what you're doing, the way to read this chart is really you're looking at waves of time, what their core is, so down in wave 0 is usually their base product and how they're going to market, what they could go into in terms of their core product that is very ROI positive or strong. So the larger the bubble, the more ROI. If you click on all these bubbles, there is an analysis and a thesis behind why they're going in a particular place here and what time frame they're going in. So the company that I'm going to show you, we did this for 4.5 years ago, and I'm going to show you what came out of that. But basically what you're doing is you're tracking the ability of the company to grow, the funds that are needed when, and what they want to be really when they grow up. So, you know, in wave 0 is their base business. Do they want to get out of that base business and get into another business that doesn't exist in the world that they may have the ability to do? You start to map that out prior to the investment. So we use venture funds to do this, and we use our private equity, growth equity funds to do this. And the way that you really could look at this is the colors that we plot up here. These are all the same color, but typically we change the color to venture funding going into a bubble versus PE funding going into a bubble. So I don't know if you kind of picture that, but if you take a company and it really has a good platform and it's leverageable, then you can start to kind of push them into other areas. And I'm going to show you an example of that. So the example I'm going to give you is an AFib company, and it started with this device right here. So this is a patch, sits on your heart, it's Bluetooth to a phone, has algorithms built in. It can read 3 different types of monitoring. So in the heart cardiac area, you look at CEM, MCT, and Holter monitoring. This device does all 3. So we started with a very innovative device, pre-FDA, took them through what I'll call the series, so all the way from A to C, and then we started to acquire around them and merge. The way we did it is we actually invested in Preventus Technologies, and then we purchased a company called eCardio, because they didn't have the next bubble in that chart in terms of actually taking the signal and doing something with it, and actually in real time getting a cardiologist on the phone or a nurse on the phone with a patient. And that's so critical to have that real-time ability in an AFib situation, because usually you have a person that's got a heartbeat of 155 for an hour, they're 80 years old, and that is very traumatic for that type of individual and can cause heart issues, heart problems, and sometimes death. So what we did is we continued, and there's some I don't even have up here because we're still working on them, but we continued in terms of care coordination. So we bought another company, merged it into with a PE fund. So we're done venture investing in this company. Now we're using the PE fund to go after the eCardio, to go after the monitoring. And the monitoring really is a coach. So you may leave the hospital, you may be wearing this, and they're monitoring you, but you don't really know what you're doing. You're 84 years old, you're taking 5 pills, you're trying to take your blood pressure, you're trying to take your weight, you're trying to get that information back to the physician or the hospital. It's very difficult for those patients to do that. So what normally happens is they end up back in the ER. Well, in the US, that costs a lot of money. So the admittance to ER is they get penalized when they come back. So you're trying to keep that from happening. With this device, you can titrate a drug, you can talk to the person, you can see real time, you can change the device remotely to trigger other alerts, other algorithms, so that the person is getting real time, really personalized care. That's interesting. That changes the dynamics, changes the game of how we take care of people and how we monitor them. And you can do a lot of other things besides just the heart areas with it. Next, we got into predictive technologies. We're starting to look at technologies that are monitoring jet engines or monitoring things that are not in the healthcare space and predictively look at the heartbeat before an AFib happens. You get a baseline and you start to read it, and we've shown it on patients where we've called them up and say, you're going to have an AFib, and lo and behold, in 3 minutes they are in one, because we can start to see that, so you're preparing them. That's game-changing, right? Now we're getting into predictive, we're getting into wellness, and not just an acute situation. So this is an example of where we took a strategic venture investment, we put PE dollars into it, into some game-changing elements and whatnot, and we were able to actually pay Merck back on the initial investment by some things we did with the acquisition, and we brought in other partners and resold pieces of the business back out. In this case, it was to Boston Scientific, and we were able to recoup our venture investments and still own about 50% of this entity, which is a very, very valuable entity. Started with $2 million. This entity is probably worth hundreds and hundreds of millions right now in about 3.5 years. So we looked forward, we came back, we went forward, and checked off the boxes of those bubbles and executed pretty nicely. Okay? How much time do I have?
You are
52. Over. Okay. Real quick.
over, correct.
Over. Real quick. This is, if you think up here, you usually deliver here. If you think here, you deliver here. This is thinking up here. So how can we put this dashboard and a dashboard of people like you as you're being cared for in front of a physician with video there, with everything you need to monitor a patient, and the data is there, and transfer it into sleep, transfer it into cardiac, transfer it into COPD, transfer it into diabetes. This is what we're doing. So that's forward thinking in terms of second level, third level thinking to take it beyond the cardiac space. I'll stop there.
Joe, quick question for you. Is it natural for you, with all of your investments that are being driven from the Health Innovation Fund, to have an eye toward progressing or maturing them to funding them from the PE fund?
Absolutely. In fact, that's what we do. So each bundle of investments are in itself, we take them through that growth framework strategy, and now you got a bunch of investments that are bubbles in a particular area, and you're looking at what they could be as they grow up or as you funnel individually each one. So it's kind of permeating out of from your many companies to down to one company, but back to the many in terms of the big picture. And that probably confused a lot of people, but
no, but you might
it is
argue,
a confusing and complex strategy, but it works.
You might argue that your application of second level thinking is the strategic analysis of what could progress from a venture fund to a private equity fund. So, exactly. All right, thank you.
Okay, thanks.
Michael, while you kick us off, I'm going to make sure everyone has water. So.
Oh, thank you. Thank you. Well, glad to be here today. As you can probably tell, I did the slides myself, so they're nice and big. I'm Mike Chisano. I'm Vice President and COO of JJDC. Johnson & Johnson, their subsidiary that does equity investments is JJDC. And just a little bit about myself. I've been with J&J for over 30 years in medical device, pharm, and consumer. And I joined our venture team in 2012 after running our corporate development group. And during the time at corporate development, we basically put strategies on new growth areas, worked with our venture team to invest, and then my job was to actually put onboarding, as we call it, or a license collaboration or an acquisition for every one of the deals that we would do. So in essence, we're a strategic investor. My current focus is consumer and med tech. So over the last 4 years, we've put together a portfolio of consumer health investments. But med tech has been one of our strongest areas of investing over the past years, with pharma kind of taking the lead in the last few. A majority of our investments, we're strategic investors. We look for a board seat on them. And as far as JJDC, it's kind of an interesting, progression since 1973, our corporate development and our CEO got together and said, you know, how do we start companies and grow them and acquire them in a way that puts us in a really novel position? Now, this was pretty early thinking, because if you look at a lot of the venture firms, this is when some of the big ones were starting. And that was really a venture fund put together specifically to acquire the companies. We progressed through various leaders, from financial to strategic to financial to both. Today we're a financial investor, a strategic investor. Yeah, I should say financial. We have 9 investors. So last year, well, just to back up a minute, from 2013 to 15, we did over 100 investments, deployed over $1 billion in capital. We don't normally publish numbers, but that was given at our analyst meeting a couple of days ago. We have 9 investors, 8 in innovation centers. I'm in New Brunswick. And we're involved with, our innovation centers are really scouts, people with strong, deep science, and really out there early scouting for technology. Our investors are there that if a structure works for venture, we help craft it early. If it's just an R&D or a lab experiment or a seed investment, we work to really craft it so that there's a pathway for every investment we make, whether it's just an R&D collaboration or equity, to something to onboard. And that, again, that could be a license, a collaboration, or an acquisition. One thing we do in our group, which we've learned over the 40-plus years, is we have an executive sponsor for every one of our investments. So J&J is decentralized. So if Biosense Webster or the Global Surgery Group or McNeil Consumer wants to do a deal, that leader at that business unit has to co-sponsor that deal with me. So if we're going to put equity of $5 to $20 million in a company, that leader is on the hook for half of that investment. Now, we invest off our balance sheet, but that creates an alignment between us and the business unit about what we're doing. We typically take a board seat, and today we're more leading term sheets than not. And so let me talk a little bit about a case study. This is CVRX. I have the name up here pretty prominently, but this was part of a strategy that we developed looking at new markets that don't exist today, nascent markets. And this was a company that had developed technology out of an incubator with NEA that really was looking at drug-resistant patients for hypertension, and how can you really address that a significant population of patients that really aren't well treated, at high risk with comorbidities for stroke and others. A lot of them have heart failure, and go after it. So after we saw this investment developed, we made an initial investment in 2007. The company did a pivotal trial on hypertension. The data on the study was very good, but they failed their first pivotal study because of safety, and it was acute safety only. And this is where they implant an IPG, or a little neurostimulator. They put a lead on the carotid, and by turning the instrument, you can drop blood pressure from 220 down to 140 just by dialing it in. Very unique technology. There's others out there with ablation and all other things, but this is really still the most novel technology on the market. What happens from that failed pivotal trial was we were doing deep research on it. When we saw the data come back, we not only saw that it was effective in hypertension, we also saw there was a signal on heart failure. So our initial investment hypothesis was drug-resistant market, significant. If this product works, will be a very big product. And what we saw was, in talking to physicians and them looking at a subset of the data, they said, you know what? If you can do this on heart failure patients, class 3 patients where there's no real effective treatment, this is big. And so that insight kind of turned around into not just saying hypertension is great, but heart failure could be significant. Right now, CRT therapy is a $3 billion market in healthcare. This product could treat these patients differently than CRT. So we're pretty excited about what the company has as a prospect. So working with NEA as a founding investor with us, and with the company and their deep science they had in their KOLs, we realigned the company a few years ago to focus on heart failure. Don't forget about hypertension, it's still an important product, but let's accelerate heart failure. So, you know, right now what we see is heart failure is the primary focus, could be very significant for the company and for patients. And, you know, one thing we really do and everything we focus on is, does it have as Joe mentioned, does it have an impact on patients? Can it really change the care and outcomes? And is it something strategically that J&J has a right to win in? You know, we can't be in every area of healthcare, but there's certain areas that we think as we go forward, we should have a right to win, and that's where we try to invest.
Michael, thank you very much. Appreciate that. As you considered the various postures you could take with that investment, what was the moment? Was it the clinical results? What was the moment of breakthrough where you thought you had something special in terms of the opportunity?
Well, I think our initial investment, there was a lot of work done. I think it's when I came in and we did extensive market research with KOLs and showing the hypertension data and a subset of heart failure data that every physician, bar none, was like, you know, you have this heart failure data. You know, hypertension's great, but if you really can do this and demonstrate that you can actually do it. Now, they just had a subset of a study, right, that was analyzed. This could be really big. So we started to dig into it more about current CRT therapy and other treatments in heart failure, and you know there was a big gap. You know, they have a lot of drugs for class 1 and class 2, and there's a lot of devices in class 4 as a bridge to transplant and others that they could do, and there's this chasm.
Looking beyond that initial data set to what might lie beneath, so appreciate that.
Yeah, and let me just, I forgot to just give a short pitch here, but this is where our investors are located. They're around pockets of innovation where we have innovation centers. We also, having 40 years plus in this business, you know, all of these are collaborations, acquisitions, or some type of onboarding. Thanks.
Appreciate it. Thank you. Bo?
Thank you, John. Do I need to click? Oh, that was too fast. All right. Thanks, John. I'm not sure I can accelerate heart failures, but we are sort of in a little bit different sector. Nokia Growth Partners is a venture capital firm which has one single LP, and it's Nokia. Today we manage about $1 billion. We announced recently a $350 million fund for investing in IoT. We've been at it for about 10 years, and we have invested in about 60 companies. I think we today have a portfolio of about 40 companies, and it has been an interesting ride. And as some of you know, Nokia has gone through a very public transformation, if we put it that way, and today is a telecom equipment company. And of course, lo and behold, last week announced a deal whereby there will again be Nokia phones in the global markets, but it will be manufactured and sold by Foxconn. So it's a licensing deal by Nokia. So what goes around comes around, and you will again start to see Nokia phones out there. I also put a few words about myself up here, and sometimes you have to wonder whether your experience is an asset or a liability. When I meet a 28-year-old entrepreneur in Berlin, I'm not going to say that I have been working for 28 years after I finished my studies, but I think in this forum here, it's kind of still okay. So I did 14 years of operating jobs in Nokia and Alcatel-Lucent, and then I did 14 years of investing, and the last 8 years with Nokia Growth Partners and building it up to where we are today. What you see here on the background, a little bit faded, are some of the entrepreneurs that we have backed over the years, and I think what I wanted to talk a bit about, what is often ignored, is people, because it's really people that make these companies. It's not the technology itself, it's not any standard process. It's not a robot yet. It's really the people that makes the difference. And one of the cases where I think we had quite a bit of second level thinking, I think we have a little bit different term. We call it conviction. How do we build conviction, and how do we build conviction out of information and data that is, to a certain extent, proprietary to us, but also a lot of data which is really public, but you think about it differently. And one of these cases was around this gentleman here, Yong Fu. And Yong Fu was not the founder. He actually came in 2006 in a company called UC Web. And the company was founded in 2004. Yong Fu was actually an investor by background, but got so excited about the opportunity in this business and took over as CEO in 2006. We started discussing with the Yong Fu in 2008. What the company was doing in China was really a proxy browser. And for those of you that are not in my sector of the industry, it's a server software that helps speed up your browsing on your phone. And it has a client on the phone, and it has also a server backend that you connect to, and it helps you really connect to the internet much faster. Now, this is China, 2009, right? There are no smartphones in China, right? Nokia has a dominant market share, and it's mostly, at that time, Series 40 feature phones. So fairly unsophisticated phones, if you will, but of course a huge pent-up need for getting access to information in China. And the mobile internet in China actually was a working class. It was a blue-collar phenomenon in the beginning, because there was not the spending or the capability to buy a PC. And if you wanted to get to the internet, you went to an internet kiosk and you logged in. So for a lot of the blue-collar workers, this was the only way to get to the internet quickly. So this was very different from what we saw in the developed markets. The other thing that was very unclear in China in 2009 is like, how do you exit? We had a lot of debates because there was no local market, so either you could go public on NASDAQ, or you just died slowly in the local market, and that's it. There was no exit market in China as such to speak of, unless you really were at that sort of breakout speed of getting to a NASDAQ public listing. His business model was not exactly obvious, and again, if you think of feature phones connecting to the internet with blue-collar workers in China, it's like, there's not a great potential for monetizing either, right? So, although when we started discussing, he was growing quickly, we knew he was on 60 million Series 40 phones in China. He was the preferred portal on the Series 40 in China. It wasn't obvious how he was going to make money. And then to top it off, Nokia wanted to develop their own product, which is not unusual, right? You know, big companies have a lot of projects, and one of their projects was they wanted to build their own proxy browser. And when we started discussing with Yong Fu, his pre-money valuation was $80 million. And again, we're speaking 2009 China, right? Today it doesn't sound like a lot of money. It was quite a lot of money at the time. By the time we were finished discussing, it was going to $125 million. And we decided, I would say, in contrast to the Nokia strategy, to invest in Yong Fu, because we just knew that he was by far the biggest guy in China. He was growing very fast, and he was building up a team to outdevelop anybody else. So at the time when we invested, he had 800 software developers. So those of you who know software know that it's not about the people always, but once you start to get that development engine going, it's just impossible for anybody outside of China to catch up with you. So when we sort of stacked up these things against each other, we said, okay, Yong Fu, he's the guy to back. We think that we can build a partnership with Nokia also over time, and that's also what happened. So actually, Yong Fu became a very, very important partner for Nokia and was also featured in a number of the product launches together with Nokia. And at the time when we exited the business in 2014, he was in about 500 million phones across emerging markets, and he was a destination for content distribution. And he made money from distributing content and, of course, also accelerating internet services. All of this in 2009, of course, was impossible to imagine. And this is, of course, one of the hallmarks also of great entrepreneurs. They expand the opportunity as they build their business, right? And this didn't happen by automatism. It happened also because Jung Fu had great foresight and great capability to execute and really building up a very scalable software machine, and had 3,000 people developing software when we exited. And it turned out to be also the largest internet exit in China at the time. And Alibaba at the end ended up buying remaining shares for $4.2 billion. And what I think makes us very happy is not that we made a lot of money for ILP, but also that today Jung Fu runs a very, very large division within Alibaba that is running most of the online services of Alibaba. So, but really from a beginning, 08, 09, where it wasn't obvious at all where was this going to go, but we developed our conviction and got behind these data and also got into really understanding the person behind this company and believing that he could make something really exceptional.
Bo, thank you. Instead of a question, just an observation, a comment, and then we'll turn it over to Jacqueline. It seems as though you've provided an excellent example, and Clayton Christensen would be quite proud, because this is an example of the innovator's dilemma solved, because you took a cutting-edge technology, applied it to the lower end of the market, bolstered the performance of the lower cost phones in the China market, and now have a pathway to take that up market as well.
That's very true, John. That's exactly what happened. And of course, we looked at all the developed markets, and everybody was talking about smartphones at the time.
Yeah.
So.
Good. Thank you very much.
Thanks, John.
Appreciate that. Last but not least, Jacqueline Lesage-Krauss.
Hi, I also did my own slides, so thank you for your patience with them. So I work with Munich Re HSB Ventures. So Munich Re is the world's largest reinsurance company. And I'll talk just a moment about what that is, because reinsurance tends to be in the background of what we all do, and it's not something that we're all familiar with from our day-to-day lives. So I'll just talk really quickly about what that is. So on one end of the continuum, if an insurance company has an auto insurance book of business, like for your auto insurance, they'll take some of that risk and then offload it to a reinsurer. Another end of the continuum is something that gets very close to what investment banks do, but without the access to the capital markets. So we'll help corporate entities, large and small, solve some of their risk needs using our own balance sheet. So we range, again, from things that would be of interest to us from the home and the auto, all the way to all sorts of aviation and space stations and satellites and pretty much everything in between. We cover all lines of insurance. We're global. We handle primary and reinsurance. We've got health, we've got life, we've got property and casualty. So cool thing about reinsurance and insurance in general is it's kind of behind everything that we do as humans. There's risks, and there's insurance companies that help us to address those risks and make them comfortable for us. So that leads to an abundance of strategic themes for us. And really, when we think about what's of interest, it's really more, what are our businesses able to do on the innovation execution front that helps us to focus, as opposed to what out there is of interest to us. We also have $270 billion in assets under management for the whole insurance company. So we have a lot of capital that, in theory, goes to help solve these risks, certainly not all of which is going towards venture. Hartford Steam Boiler is a small subsidiary of Munich Re, but it's one that is known within the group for being the most innovative, highly profitable, and growing. It's also where our corporate venture group got its start. It itself is the largest insurer of equipment. We also do cyber insurance, energy-related types of insurance, and we have a really unique business model where we sort of create the intel inside, or the product that goes inside other insurance companies' products. So instead of them creating the product and us taking the risk, when it comes to our, say, equipment breakdown flagship product, we actually develop the product ourselves. And that leads to one of our main strategic themes, which is the Internet of Things, which is what I'll end up talking about in a moment, and where my group has been heavily involved. Munich Re HSB Ventures, so we're the young one of the guys that are on the stage. So we just got started in December of 2014, and we had this really sort of flip situation from what normally happens with corporate VCs and with which I'm familiar with. So Instead of starting at sort of the CEO level, we started within Hartford Steam Boiler, the subsidiary. And the last year and a half has been sort of an awkward process of manifest destiny as we went out from Hartford Steam Boiler to the reinsurance group to now, as of the past few weeks, all of the Munich Re group. So we've been sort of expanding our mandate, and with that goes all the sorts of engagement with different stakeholders that goes on in order to create the pathway for the business. So as a result, our capital and structure is in transition, but I wanted to point out something really striking from who's on stage today. And I don't know that I've ever seen this before with a corporate VC panel, and I started doing this in 2008. With the exception of us, all three others are a separate entity. They're an LLC, they're a corporation, or they're set up as a regular sort of fund. And I think that's a trend that we're seeing in corporate venture, and it's one to pay a lot of attention to. And as I mentioned, we're in the process of looking at our capital and our structure, so we're in transition. When we look at our goals, we're strategic and financial, like most everyone else. So we start with the strategic goals, but everything's gotta map out financially. Our strategic themes, so Internet of Things, cyber, insurance tech, big data, a lot of different areas that are relevant to us, and it's expanding from there. We'll probably be adding health pretty soon. Stages, we're stage agnostic. We've mostly done earlier stage, but I see us doing later stage as well. We're active investors. We'll lead, we'll follow, we'll take board seats, we'll do board observers. Also, everybody on the team have previous investment experience. We've all come from other corporate VCs or from traditional VCs, and we plan to keep it that way for the investment professionals. And then also, when I do corporate VC, I think it's really important to have a direct connection to the businesses. And so we have someone on our team for Hartford Steam Boiler who sits there at Hartford Steam Boiler and is very involved in business development. And then we're working with the rest of our Munich Re colleagues to set up that same sort of engagement, although perhaps with a different structure. In terms of me, I first started doing corporate VC in 2008. I formed and led the corporate venture capital and incubator group for the Hartford. So I've somehow found this bizarre niche of corporate VC and innovation in insurance companies. And I love it. And I joined Munich Re and Hartford Steam Boiler in December of 2014. So that's a little bit about us. And now let's talk about our example for second level thinking. So this is a very recent deal that we did, so we're not able to talk yet about how it's going to play out going forward, but it's more about thinking about the decision that we made to do this investment. So we've been active looking at the IoT space from our perspective for the last year or so. My team is also very involved in the IoT strategy for Hartford Steam Boiler, as well as the rest of Munich Re. When we look out there, we see all sorts of activity, right? There's an abundance of companies doing various levels of the stack in Internet of Things. And we've had to try to decide where do we want to play in that. And as we chose to make our investment decisions, what we realized is that, yes, it's all about the data. So Sue Siegel earlier talked about how a lot about sensors and Internet of Things is about the data, and we agree with that. However, we've been doing 2-3 years of piloting with our end customers around different types of risks, and we have found something else. It's also all about the operational aspect of how you execute these, and if you don't get the operational aspect correct, which has a software and a hardware component to it, it takes out the economics. It makes it extremely difficult to be able to execute, and it also potentially sets it up so that the data is going to be basically worthless. So we have some insights that we have from our pilots that helped us to find the certain operational types of things that we thought were very important to us. And as we were looking around in the market, we found Helium, who had a very common vision. And there's many things about them that are about setting up the data, but there's also choices that they've made around how they set it up operationally for end customers to use their technology and their business model that works very well for us and helped us to decide to make that investment and to also go forth and partner with them. So we just, within the last month, we did that investment. We joined a $20 million Series B round. It was led by GV, and Khosla was their Series A lead and also continues to be a big investor. So we joined them in that investment, and we're excited to see what's going to happen over the next couple of years with them.
And so Jacqueline, just to round us out for this session, your application of second level thinking was about an understanding of your own core operations and how this company specific to your company would find a good fit and be able to extract value from Helium that maybe others couldn't?
Yeah, and actually it goes two ways. So part of it is about the synergy that we have in terms of our plans, but it's also those plans can mean very, very good and positive things to Helium from a go-to-market standpoint. So it ends up going both ways in terms of the value that's delivered.
Good, thank you. If everyone could join me just thanking our panelists today.